Welcome to Money and Banking. This is going to be the first session where we'll go over a broad overview of what we'll cover during this course. And it's a gentle introduction into the topic of money, banking, and the financial system. And as the course progresses, we'll take each of the terms that we introduced during this session and go into an in-depth treatment of it all. All right. So the goal for at least this session is to basically talk about what we mean when we say the financial system, when we say money, banking, and the financial system. What exactly are the key components of the financial system? And as a motivating start of this entire discussion, we'll quickly go over the financial crisis of 2007-2009 to see why the things that we are going to study here matter in the real economy, right? So that's what we'll do. And as the course progresses, everything that we introduce here, we are going to go ahead and do an in-depth treatment of each of these topics that we'll introduce during this session, and that gives you a kind of a roadmap of how the course is going to unfold. Okay, so let's get into it. So let's start with a very simple situation, right? So you have a bright idea, and then what? Right? So suppose you have this idea for a smartphone app that will deliver a chapter of a textbook for a small fee. Right? Now, this seems like a reasonable idea. Textbooks are expensive, and you don't need all the chapters in the book. And for a small, low price, you come up with this idea that you're going to deliver this textbook chapter to a student's phone. Okay. So far, so good. The idea seems promising. It seems like a reasonable idea to work with. What comes next, right? To get this idea off the ground, the first thing you need is to spend a lot of money building out the app, the infrastructure surrounding it, hiring key people in order to manage this app, and so on and so forth. And as a budding young entrepreneur, you don't really have access to that kind of cash to get this idea off the ground. And that's where the financial system comes in. So at its very core, when you really think about it on an intuitive level, what the financial system is there to do, it is to basically match savers who have money to lend with borrowers like you, right? So this is a crucial function that the financial system provides, that it matches up savers and borrowers in the economy, and that allows for investments in new businesses and new business generation and new ideas taking root, and then that becomes the engine, the workhorse of growth inside the economy, right? So if there is a significant disruption in this flow, in this financial system, that's what we mean when we say a financial crisis, right? A financial crisis is basically a disruption of this flow of funds from savers and borrowers. And if the disruption is severe enough, as it was in 2007, then we might have a calamitous situation on our hand, which freezes up the thriving parts of the economy, right? So in 2007, 2009, what we saw was the first recession in recent memory. Since the Great Depression of the 1930s, this is the worst recession that has occurred in the US economy, and we'll talk about it in sufficient detail. So towards the end of the course, we'll do a few case studies where we'll talk about the panic of 1907, we'll talk about the Great Depression, and then we'll talk about the Great Recession of 2007-2009. And as this textbook and our understanding gets updated, I'm sure that we'll use the coronavirus pandemic as a case of significant disruption to the economy. It's not a massive disruption to the financial markets per se, and we'll see why that's not a massive disruption to financial markets in general, but it is a significant disruption in the overall real economy. And as the discussion progresses towards the end of the course, we'll begin to talk about some issues dealing with the coronavirus and how that has impacted the economy, right? But that's the key idea here, right? So we need to understand the financial system because its primary function is to match up savers and borrowers together, and that matching, if done efficiently with very low transaction costs and very few frictions, that is the basis of growth inside the economy. Okay. So let's talk about the key components of the financial system. And when we talk about the key components of the financial system, we would like to think about three building blocks or three pillars that hold up the edifice of what we call the financial system. The first thing that we need to consider is financial assets. These are the units, these are the building blocks of the financial system. So what do we mean when we say financial asset? Okay, so it has two terms to it, financial and assets. So let's take each of them in turn. So an asset, as the name suggests, is anything that has value and can be owned by a person or a firm, right? Anything that has value is owned, that there's well-defined ownership rights, well-defined property rights over that object of value, then that becomes an asset. A financial asset, on the other hand, is a very specific kind of asset. So it's still an asset, which means that it's a thing of value which is owned by a person or a firm, but it has an additional feature that it has a claim of payment on someone else. Right? So financial asset is a claim where some kind of a payment is owed by someone else who either owns the asset or is owed the asset. Okay. So that's the building blocks. These financial assets are basically claims of for payments, for cash flow in technical sense, on somebody else. Okay. Now these financial assets need to be traded among different people, and that's the second building block. So there, with the financial system, there is a lot of plumbing metaphors which are thrown in. So the financial assets are the basic units, and now you need the piping, the plumbing around the system which moves these units through it, right? And that's where financial institutions come in. Financial institutions are specific entities which facilitate this movement of financial assets through the system. And on top of it, on the third layer of it, if you think about the abstraction, there's financial assets which are the basic building blocks. Then there's the plumbing which is surrounding that movement of these financial assets, what we call financial institutions. And on top of it, the regulators. And the key regulator, at least in most economies, is the central bank. And in the US, the central bank is referred to as the Federal Reserve. And these are the financial regulators. These are the primary function of the central bank and the financial regulators is to perform a watchdog role and to intervene when necessary if the plumbing begins to leak and if there's some problems with the movement of these assets through the system. Okay, so we'll take each of these things in turn and discuss them in a broad sense right now, and then we'll go into them in more detail as the course progresses. So let's talk about financial assets and what we mean by them. Okay, so one key aspect of financial assets is what we call securities. Right. So again, remember that there's three layers to this definition. So an asset is anything which has value, which is owned by a person or a firm. A financial asset is anything which is, first of all, an asset with the additional feature that there is a claim for payment on someone else. And a security adds in the third feature, which is tradability, that this asset, this financial asset, this claim for payment can be traded among different participants in the market. Okay. So as soon as you introduce this element of tradability, and you can go back to ancient times here, as soon as you need trade, the market mechanism seems like the best, most efficient way of facilitating trade, right? So with inside trade, if you think about how the economy functions, it's about using comparative advantages to create goods and services that you have a significant comparative advantage in, and then trade it with other people who might have different comparative advantages in producing different goods and services. So the key element of this entire thing is that there needs to be a double coincidence of wants, which is a fancy way of just saying that for trade to happen, for trade to take place, I need to have something you need, and you need to have something I need, and then we can set the terms of trade on what ratio we'll trade the things that you and I have. Right? That's basically the key notion of how trade happens. Now, straight away you can see what the bottleneck could be, that there might be significant search costs, right? So for me to trade what I have, I need to find somebody who's willing to accept what I have. That's the first part of it, right? But at the same time, the person that I find needs to have something that I want and is willing to trade it. That's what we mean when we say double coincidence of wants, that's the precursor to any kind of trade to be successful. Okay, now if you go from, you might start from your neighbor's house and then see if they have something you want and if they're willing to trade it, and keep going, and in a small community this might work. But once you abstract to an economy which houses billions of people in it, now you need a system, a centralized system, a system where people can just get together, meet, and look at all the goods and services that are available for trade, and then settle terms on the trade and go through with it. Right? And that's what we call a market. As the same thing with the financial market. The financial market is just a market mechanism, but the objects that are being traded are not commodities or goods and services, but rather what we are trading in this market are financial assets, which are claims for payment on somebody else. Okay. So we'll talk about some different kinds of financial assets. We'll talk about stocks, bonds, and other securities, but that's basically the elemental blocks of the system, of the financial system, is that there's a market in which we can trade these different kinds of securities. So what we call securities are just financial assets which have the additional feature that they are tradable, that they can be transferred from one person to the other for some kind of payment. Okay. So at least in this course, we'll talk about 5 key categories of financial assets. So we'll talk about money, right? What is money? We'll talk about stocks. We'll talk about bonds. We'll talk about foreign exchange, and then we'll talk about securitized loans. Okay, so these are the 5 key units of financial assets. These are the most dominant units of financial assets that get traded on the financial markets. So there's a lot of other very niche and boutique financial products that can be traded on the financial market. We won't get into all of that in this course. We'll talk about the big broad strokes of how the money, banking, and the financial system work and operate. But if you have a reasonable understanding of these 5 key financial assets, that's a good starting point to understanding the financial system. Okay, so let's take each of these assets and introduce what their features are and what they look like. And as the course progresses, we will go and conduct a more in-depth treatment of each of these asset classes. The first asset that we'll talk about on this course is what we call money. And it's intuitive enough, everyone knows what money is. Money is anything that can be generally accepted as a form of payment for goods and services, or to pay off any kind of outstanding debts, right? Now, that seems reasonable enough, but straight away it's not as simple as that, right? So we can think about money, and we'll in the next session we'll start an in-depth discussion about money and its evolution over time, and what managing the money supply looks like in the modern world. But straight away you can think of money in 2 forms, right? So money can take the form of what we call commodity money, and it also can be in the form of fiat money, right? Commodity money has this interesting feature that it has intrinsic value, which is to say that beside acting as a form of payment, as an acceptable form of payment, whatever we're using as money has value in and of itself. Right? For instance, a bag of wheat, right? Okay, in a pre-modern era, a bag of wheat could be considered a form of payment, right? If your neighbor needs wheat and he does some gardening work for you or whatever it is, and he'll accept wheat as a form of payment, now it serves its function as money in the sense that it is a form of payment. It's accepted as a form of payment for goods and services, but at the same time that bag of wheat has intrinsic value, right? Even if it is not accepted as a form of money, it can just be consumed and you can get some value out of it. So commodity money is anything which has a dual function. It has intrinsic value in the sense that it can be consumed directly and some amount of value can be derived from it, and also it serves as a form of payment, as a generally accepted form of payment, as opposed to what we call fiat money. Fiat money is what we are generally think of when we think of money. A dollar bill is a form of fiat money. A dollar bill is a piece of paper at its very core, and it doesn't have any intrinsic value. Okay, you can argue that it might have some small intrinsic value. You can set it on fire and get a bit of warmth for a second, but realistically the intrinsic value is basically non-existent, right? So all of the value of this piece of paper is derived from fiat. Fiat is a fancy way of again saying a government decree or government order, right? The piece of paper only has value because someone says it has value, and the person who is in charge of saying it has value has some level of credibility associated with it, right? So with fiat money, there's no intrinsic value. Its only function is to its only form and function is to operate as a form of payment for goods and services or debts, but that's about it. It has no intrinsic value in of itself. So when we get into the discussion around money, this distinction, the history of what used to serve as money and how we've translated all of that history into this more modern world where fiat money rules the roost and we don't really see any kind of commodity money anymore. That's an interesting story in and of itself, but straight away you can see that discussion around money can begin to get complicated. The other key element that we want to talk about with money is how much money there is available inside the economy, and that's what we mean by the money supply, right? Is the total quantity of money that is floating around the economy at any given point in time, right? Then the question obviously arises, how much money do we need to service the needs inside the economy, right? That's the first order question. How much currency should we print, right? The second question is, if we print too much currency, is there going to be a problem, right? Okay, so if you think, okay, as much as we need it, is there a problem with overprinting currency? Is there a problem with having too much money supply? We'll talk about that. We'll talk about who is in charge of managing the money supply, who gets to print and who gets to decide how much money should be supplied into this economy. And that's the third key element that we'll talk about when we'll talk about money. So this is again a brief introduction into the world of money banking and the financial system, but we'll take each of these things in detail as we progress through the course. Okay. The second key financial asset that we'll talk about is stocks. Okay. So what are stocks? Stocks represent partial ownership shares in firms, right? So these are also called equities, these are also called shares, whatever you want to call them. But stocks are financial securities. Again, remember, these are securities in the sense that they're tradable. I can transfer stocks and shares from one person to the other. That's what makes it a security. And they're financial assets in the sense that there is a form of claim of payment on somebody else. Okay. And the question then becomes, why would you ever want to own a stock? If you own a share in Microsoft, you own part of Microsoft, right? You become a shareholder and you own a part of Microsoft. You're a part owner of this corporation that we'll call Microsoft, right? Why would you want to be a part owner in this corporation of Microsoft? And historically, the answer has always been dividends. Okay. What are dividends? So you become a part owner in Microsoft. Microsoft is a great business. It makes all these amazing products. You sell these products and realize some profits. Now, because you're a part owner of Microsoft, you are entitled to a portion of these profits, right? Technically speaking, you're entitled to all the profits that the business generates, but you might want to not claim all of these profits right away. You might want to invest in the firm a little bit more to fund new investment opportunities which might come out of the profits that you're generating. So you don't have to put in any new money into the firm. You essentially roll over some of your profits, what we'll call retained earnings, to fund future investments in the firm. But what you're entitled to is a portion of the profits that this firm generates, and there is no theoretical limit to how high these dividend payments can be, right? The theoretical limit on the downside is zero, that the firm issues no dividends at all, but on the upside it could issue any amount of dividends. And that's the crucial reason for why historically people have invested in stocks, is to receive dividend payments from this ownership of this firm. Okay. There is a second avenue, which is the more recent version of it, what we'll call a trading version of this stock market, is to realize what we'll call capital gains. This is the classic buy low, sell high function in trading, right? So if you can buy a share of Microsoft for $100 and then you're able to sell it to somebody else a couple of years later for $200, the $100 that you receive extra is your profit, and that's what we'll call a capital gain. It's not coming from dividends per se directly. That's the value is not coming from dividends per se, but from selling your ownership stake to somebody else and receiving a payment for it. Okay, so that's two primary reasons for why you might want to own a stock. One is to get dividend payments from ownership of the stock, and the second is maybe to speculate and to get capital gains from ownership of the stock. Okay, so we'll talk about what is a fair price for a stock. We'll talk about stock valuation, how do we value stocks, what seems like a reasonable methodology for valuing stocks to realize how to, whether it's worthwhile to buy a stock at a current price level or not. It's much more complicated than that, but we'll get into all of that when we'll talk about stocks in more detail. So that's the second key element that we'll talk about in this course, is about stock valuation. Okay. The third financial asset that we'll discuss in this course are bonds. Okay. Bonds are financial securities as well, but they are basically debt instruments, which is to say there is a promise to repay a fixed amount of money. Here, let me get a pen. That repay a fixed amount of money, right? So a financial security can be issued by a corporation or a government, and the promise is that not only does the amount that you lend come back to you, the principal, which is what the amount of money that you lent is called, the principal that is owed is returned to you, but you might also receive an additional payment on top of the principal for having lent that money and for carrying the risk that that principal might not be returned. That's what we'll call the interest rate. The interest rate is the cost of borrowing funds or the payment for lending funds, and is usually expressed as a percentage of the amount borrowed, right? So when we talk about interest rates, we'll usually talk about them in percentages. So if you lend someone $100 million to start up their own business, you can negotiate terms on which that money gets returned. So you not only get your $100 million back, obviously you want that, but there is risks involved, so you might want an additional payment for lending that money out, right? And it's not completely obvious why you need a positive interest rate and how high this interest rate should be, right? It's not immediately intuitively it might make sense that there is something called risk involved in this entire enterprise, that principal, there is a principal that might not get returned. Okay, if it doesn't get returned, then the interest payment doesn't make any sense. If you're not going to get your own money back, what effect? It doesn't matter if the interest rate is 100% or 1,000%, you're losing money on that entire enterprise. Okay, now the interest rate is an interesting idea. So we'll get into why we need an interest rate, what that interest rate needs to capture. It will spend a lot of time on interest rate, and why generally speaking we have positive interest rates, and in this new strange world that we live in, we are also now for the first time seeing negative interest rates, right? A third of European government bonds are now trading at negative interest rates, and you can straight away see what a negative interest rate actually signifies, that you lend money and you get back less money than you lend, right? A negative interest rate is basically saying you give me money, I'll spend this money, and then if you lend me $100 million, I'll give you back $98 million in 5 years' time. That seems strange, and it is strange. For the longest time, we had this theoretical understanding that interest rates can never be negative, what we call the zero lower bound, right? That interest rates are bounded by zero on the bottom, that we can't have interest rates drop below zero, because that doesn't make fundamental intuitive sense that you would have a negative interest rate in the economy. But that's the world we live in, and we'll talk about what implications proceed from that realization that interest rates now can be negative. Okay. So that's the third kind of security we'll talk about, this bonds and how to value bonds, and how interest rates are determined, and how they're influenced by other factors in the macroeconomy. The fourth kind of financial asset we'll talk about in this course is foreign exchange, right? Foreign exchange is very straightforward. It refers to units of foreign currency, right? So it's a simple example, right? If you want to buy foreign goods and services, those foreign goods and services are priced in the currency of that foreign country, right? Suppose I want to buy something from India, the Indian government issues its own currency, which is called the rupee, and now the domestic merchant there from whom I'm making these purchases will want rupees, because if I give him dollars, there's not much they can do with these dollars, right? Like if there is no way to convert them into rupees, and dollar is not an accepted form of payment in any store, no store owner is going to accept a dollar bill as a form of payment. There needs to be some kind of mechanism to convert those dollars into rupees. And that's what we talk about in foreign exchange. When there is a basket of other currencies, when there's no unified global currency per se, when there's a basket of other currencies which are available, how do we go between those two currencies, right? What determines what ratio in which these currencies get traded off, right? So it doesn't seem reasonable that like a dollar, it seems intuitive that okay, if 1 unit of one currency should be equal to 1 unit of the other currency, and that doesn't really make that much sense, right? A dollar bill might represent the ability to purchase a bigger basket of goods than a rupee note, right? So therein lies the conundrum of the entire enterprise, right? If I go to the same store with a dollar bill and a rupee note, the dollar bill might purchase a bigger basket of goods and services versus a rupee note, and I need to adjust for the fact that there's differences in purchasing power between the two currencies. This is the idea that we'll call purchasing power parity, and that how do we adjust for that essentially translates into what is the right ratio in which I trade off a dollar note for rupee notes, right? Trade off 1 unit of one currency for some other currency. Okay? So that's what we'll call the exchange rate. The exchange rate tells me in what ratio I trade these currencies off, and as the course progresses, when we get into the discussion around the exchange rate, we'll talk about how this ratio is determined. Okay, banks are the largest buyers and sellers of foreign exchange because now that you have a centralized system. So instead of you going around figuring out how to convert all of this, you make your payment in dollars to your merchant in India. The merchant in India takes these dollars, goes to the bank, gives the dollars to the bank, and the bank in turn converts them into rupees, and now everyone's happy. The transaction is complete. The bank has dollars, so if the bank wants to conduct business in dollar denominations, so if it wants to buy bonds from the US government or something else, it needs dollars, so it doesn't have to go buy dollars every single time. It'll hold these dollars in its foreign exchange reserves and use that to finance foreign purchases, and then the entire enterprise goes through that way. Okay, so that's the fourth key asset that we'll talk about, what we call foreign exchange. Okay, the fifth asset that we'll like to talk about is securitized loans, right? It's a specific kind of debt obligation. This has a very interesting feature, which is what we'll call securitization. Okay, and to go back to this, here's a nice little story that you can imagine, and intuitively it should make sense for why securitized loans are such a nice clean idea. It's a nice clean innovation in financial markets. This is double-edged. We'll talk about all the double-edged part of it, but let's talk about the primary impetus of this. Historically, if you look back at what banks were traditionally in the business of, they lent money, with the intention of collecting interest payments. Right? That's all banks were designed to do. Banks are basically money lenders, in a small community. Who the person with a lot of clout and money who is willing to make loans, who we might call a money lender. Banks are just a big operation. They're a big money lending operation where they lend money that they take in the hope of collecting interest payments and then realizing a profit. We'll talk about banks and how they operate and commercial banking in general in more specific details, but that's basically the reason for which banks exist. Now you can imagine a very simple case. You're a small bank, you have taken in $100 million in deposits in your bank, and then you start lending this money out, right? And let's say you are interested in primarily lending to people who want to buy houses, right? You are basically underwriting what we'll call mortgages, right? So, someone comes into your bank, they want to buy a house, they don't have enough money to buy the house outright, so they want a loan for it, right? So bank looks at their situation and says, okay, yeah, we'll lend you money at this interest rate, and go ahead, go buy that house. And if you default, what we'll do is we'll take the house. You don't owe us anything. We'll just take the house, and then we can do whatever we want with the house. So that's basically a collateralized debt, and we have that situation there. And the bank goes about doing this business, and it's very successful at it, and it lends out all of this $100 million. Suppose the interest rate that is charging on this mortgage is just 4% per annum. Now the bank starts to realize a nice little profit of $4 million on its portfolio of $100 million loans, and this seems like a reasonable enough operation. Now suppose one fine day you're going about your business, all of this is great, and there is an entrepreneur, let's call him Bill Gates. This is 1983 or 1982, and Bill Gates walks into your bank and says, I have this idea for this technology company that I'm going to call Microsoft, and this is the business plan. I didn't think it's going to be extraordinarily successful. I have a reasonable track record and all of this, and the bank is very interested, and Bill Gates says, you know what, I need about $80 million to fund my business to get it off the ground. Now the bank really wants to be in business with Microsoft, wants to invest in Bill Gates, wants to lend to Bill Gates because it thinks it's a great idea, and the returns might be astronomically higher than what they're earning on their mortgage business. But besides asking for more deposits, which is very cumbersome from you need to go find new people to make deposits into your bank and do that in a large enough scale for you to get that $80 million and quickly enough that you can get that funding together so you can fund Bill Gates, because otherwise Bill Gates is not going to wait around for you to find the money for him. He's going to go to the next bank with the same business plan. Here's the idea, right? You go to your neighbor bank. Your neighboring bank has always wanted to be in the mortgage business, but you corner that market, right? You underwritten $100 million worth of mortgages, and the other bank is really struggling to get a foothold in the mortgage business. So you go to the other bank and say, look here, I have a portfolio of mortgages worth $100 million on, in principal, and that's the portfolio, is the principal that I've lent against, and is going to earn a 4% return. So I'll make you a deal. How about I sell you this portfolio? Now you'll have a mortgage portfolio that you always wanted, and in return, why don't you give me $101 million? Okay, so I'll sell you this mortgage portfolio, and then you give me $101 million, right? The bank is more than happy. Your neighbor bank is like, okay, this is great. So they pay you $101 million, take the mortgages off your hands. Now they are the ones who are in charge of collecting the interest payments on those mortgages, and they're very happy. They're in the mortgage business. You're very happy because now you take your $100 million, go back to your bank and talk to Bill Gates, and it's like, here's $80 million and go start Microsoft. And in a few years, that $80 million, and Microsoft has grown into like a $800 million business or whatever it is, and now you're really happy. That is the entire reason for why banks have begun to sell loans on financial markets through this process that we call securitization, right? This is to inject liquidity into the banks, right? This is a way of taking illiquid assets that the bank owns, like a loan portfolio, and turning them into liquid cash, which can be reinvested in other more productive opportunities that come around. Now, securitization is a fancy way of just saying this is the process in which we convert loans and other financial assets that are not inherently liquid, that are not inherently tradable, but turn them into tradable securities which can be traded between different counterparties in order to inject liquidity into the system. Okay. So we'll talk about all of this. A loan, a quick note here is that a loan is what we call a financial liability. So as opposed to an asset where the claim, so the difference between an asset and liability, if you have a claim on somebody else for payment, that is an asset, right? In a foundational sense, that's what we'll call an asset. I have a claim that this other person needs to make a payment to me, that is an asset to me. If the claim is on me, that somebody else has a claim on me to receive payment from me, then it becomes what we call a financial liability. Okay. So financial liability is a financial claim owed by a person or a firm. So that's the difference between an asset and liability. There's a quick little note here. Right, so that's the fifth kind of asset that we'll talk about in this course, about this process of securitization. How it's a very powerful idea because it turns previously illiquid, untradable assets into tradable securities, which seems like a great idea and principle, but it also comes with severe downsides, and we'll talk about all of that in this course. Okay. All right. So second element of this financial system that we'll talk about is about financial institutions. Now, a financial institution, a financial system, as we said, is basically a simple, uh, in its core sense, a very simple idea. It's a system through which we match savers and borrowers together. Okay, and the units of this financial system are what we call banks. What we generally, when you think about who can facilitate these transactions, generally we think about banks, but there's also other financial intermediaries, right? A financial intermediary is anything which is any financial firm which borrows funds from savers and lends them to borrowers. So anything which does this essential function where they're borrowing money from some people and using that money to lend to some other people and collecting the spread in between, right? That could be called a financial intermediary. A financial market, on the other hand, right, the other channel that there is through a financial market where there is direct trading of securities, where this borrowing and lending is happening directly through a centralized market mechanism. That's what we'll call a financial market, right? So financial markets can facilitate two types of flow of funds. There is indirect finance. So indirect finance is anywhere where the borrower and saver don't know the identity of each other, and they indirectly go through financial intermediaries such as banks, right? So as a depositor in a bank where I open a savings account at JP Morgan Chase, I know that I receive a small interest payment from JP Morgan Chase for depositing my money at their bank, but in return I don't know what JP Morgan does with my money. They take the money that I deposited and use that as a basis for making loans to other counterparties, but I don't know the identity of where my money is going, right? Who JP Morgan is lending this money out. The other kind of flow of funds that we might have is direct finance. Direct finance is a notion where the savers and borrowers, there's no financial intermediary in between. They directly meet each other, friends and family and your neighbors, other small businesses are generally financed through this channel, where savers and borrowers just know each other, they meet and they discuss terms, and then they essentially end up borrowing and lending money. Okay. Alright, and so here's a quick little guide to how funds move through the financial system. So we have savers on one side of the economy, borrowers on the other side of the economy. Now, the direct finance just means that these savers and borrowers can meet each other, but this is really difficult because there's this double coincidence of wants problem. So the financial system is basically steps in the middle and facilitates these transactions. So savers go into either financial markets and invest money directly through financial markets in corporations, and this financial markets takes these funds and channels it to borrowers who need money. In return, the borrowers either repay in the form of interest payments or through some kind of dividend payments, whatever, let's call them returns, and then these returns get the financial markets then generate these returns and return them to the savers, right? Similarly, financial intermediaries again take funds from savers, channel it to borrowers. In return, they generate returns, and these financial intermediaries pass it back on to the savers. And this in between is the financial system, right? So, financial system is basically created to solve a critical pain point in the entire process, right? Of savers finding appropriate borrowers and borrowers finding appropriate savers. Now, to go through this entire process, the financial system steps in and says, you know what, you don't savers, you don't have to go looking for borrowers, hey, you don't have to go looking for savers, you can come to me and give me your money. Borrowers, you can come to me and I will lend you money, and now I solve this pain point in this entire system, right? And straight away you can see how financial intermediaries and financial markets can make a ton of money, is that they can charge a small fee for facilitating this transaction, and as long as the volume of transactions going through this financial system are sufficiently large enough, a small percentage of a large pie is a very big chunk of that pie, right? So that's basically how financial intermediaries and funds make money. So if I lend money at 5% and I have to return money to savers at a 3% rate, that extra 2% that I can generate, I can pocket, right? And that's kind of a crucial element of any new business, if you're thinking about it, is to figure out what a pain point is and how you can solve it, right? To identify a pain point, see if you can solve it, and solve it in such a way that people would pay money for that problem being solved. It's not just enough to find a problem that can be solved and you solve it, but no one wants to pay you any money for doing that because they can do it in-house, right? Or something else. If it's very easy to replicate, then there's no sense in doing that. But if it's something that is valuable and you're solving a pain point, then there seems to be the genesis of a good new business. Okay. All right. So when we talk about financial institutions, we are going to talk about financial intermediaries in general. So the most important financial intermediaries are what we call commercial banks, right? So commercial banks, their primary function is to take in deposits and then use these deposits to make loans, right? So who borrows money from these banks? Households. They might rely on borrowing money from banks to purchase big ticket items, right? The standard ones are basically a mortgage. A house is a big ticket item that you might want to purchase, but you might not have like sufficient amount saved up to buy a large asset like that, so you go to the bank to get a mortgage and then you can buy a house. Firms also rely on banks to meet their short-term and long-term needs for credit, right? So suppose you have a purchase order that someone is committed to purchasing $1 million worth of goods and services. It costs you $500,000 to produce those goods and services. You might not really have that money on hand to make those goods and services right away. So you go to your bank and say, okay, so I have $1 million worth of goods and services, a purchase order here. I need $500,000 as a loan, as credit. And in return, I'll give you back your $500,000 once the transaction is all over. I'll give you back your $500,000 and an extra $10,000 for your troubles. Okay, so in that way, I can now, with the use of credit, I can realize these gainful opportunities, right? So now I get back $1 million instead of realizing a $500,000 profit. Now I realize a $490,000 profit because I borrowed money from the bank, which is still fine, right? Because the other option was that I would generate zero profit because I wouldn't be able to finance the transaction. So commercial banks, that's basically their primary function, is to take in deposits and then turn them into loans. But that's not the only kind of financial intermediaries we have. We have savings and loans banks, credit unions. These are what we call non-bank financial intermediaries. Their big difference is that there is legal distinctions in how these institutions are regulated relative to commercial banks. Commercial banks have more stringent regulations because the scale of their operations is much larger relative to credit unions and savings and loans banks, where they operate in small communities and their regulations on them are much less severe. Okay. A third kind of financial intermediary that we could talk about are what we call investment banks, right? Investment banks basically operate inside financial markets and assist in underwriting stocks and bonds, right? So a corporation wants to borrow a ton of money, like $100 billion they want to borrow in order to finance their operations. Now it's going to be extraordinarily cumbersome for this corporation to form a team, go find investors who are willing to invest in this firm and they commit large amounts of capital for long durations and do all of this. So instead it gets outsourced to what we'll call an investment bank. So the corporation taps one of these investment banks, Goldman Sachs, Morgan Stanley, there's a lot of big investment banks, and tells them, hey, we're looking for $100 billion in a bond issue, in a debt issue. How about you go find us investors who can do this, and for facilitating this entire thing, we'll pay you a small fee. And Goldman Sachs is in business, right? So they go find big ticket investors and collect money from them, promising some amount of returns, and then they charge them a small fee for that. And now you're in business as an investment bank, right? So we'll talk about what it means to underwrite stocks and bonds in more detail when we talk about going public and issuing bonds in the bond market and so on and so forth. But that's another kind of financial intermediary which solves a pain point in the market. Other financial intermediaries, insurance corporations. So insurance business is very fascinating, right? So insurance business is based on this idea that if you pool risk and collect premiums on insuring against that risk, as long as only a small proportion of that pool is ever going to draw down on the insurance, you're in a golden business, right? Because you collect these premiums. So for instance, if you buy auto insurance, you make premium payments every month to your auto insurer, and they collect these premiums. And if your car gets total or you get into an accident, then the insurance company steps in and carries the burden of everything that goes on after that, right? Now, as long as you don't have an accident, now the insurance company just has to collect premiums, right? So that's a good business to be in. But you don't want to sit on these premiums, right? As an insurance company, you don't want to just sit on this pot of money that you're collecting each and every single month and not do anything with it, because that doesn't make any sense. Because if there's positive inflation in the economy, that money is always going to lose value. It doesn't make much sense to just sit on that big pot of money. So what do you do instead is that take those pension premiums, the insurance premiums that you're collecting, and then go invest them in the financial markets, right? And that not only can generate profits, it also helps you better finance all the claims that might come and other costs that are necessary to manage this business. So insurance companies are big financial intermediaries. Again, these are channeling funds from one institution. So these are not in the form of deposits. That's why they're distinct from banks, because these premiums are not deposits. These are payments for some kind of an insurance product that has been sold. But you take those premiums and then channel them into the financial market to borrowers who need it. Okay. Other financial intermediaries, pension funds, similar to insurance companies, where they're collecting all these payments over the lifetime of a worker, and once the worker retires, they have to pay back, make periodic payments in the form of pension payments to service the retirement of that investor, right? So they're collecting these contributions, and then they make payments during the workers' retirements. And all these contributions, you don't want to just leave them there, right? And you don't want to sit on the spot of money again. You want to put it to some productive use, and then you might go invest in some in the financial market. So pension funds, if you look at the largest institutional investors on Wall Street, some of the largest institutional investors are pension funds. So if you are interested, there's the Ontario Teachers Union's pension fund, which is a very large institutional investor. There's what we call CalPERS. There's the California Pension Reserve System. So they are in the business. They're one of the largest institutional investors on Wall Street. But you can see that they primarily operate as a financial intermediary. They're collecting all these payments for pension benefits from people during their working periods. They take all of these payments, invest them in the market, and once the workers retire, they're going to return or service their retirement. Mutual funds are an interesting idea. Mutual funds they're not a particularly new idea, but the scope, the extent to which mutual funds are now available to small mom and pop investors is tremendous. And the basic idea is very straightforward, right? Suppose I'm a small retail investor. I have like $1,000 to invest. Okay, with $1,000, like, okay, what can I do with $1,000? Okay, I have to do a lot of research. I need to figure out what companies are good, where can I invest, how much return should I expect, is it a good price for me to buy these shares, and do all of this work. Okay, so that seems like a lot of work to invest $1,000, but it's the same amount of work to invest $1 billion, right? I don't have to do much additional work. Yeah, there is more additional work, but that's marginal work, right? The amount of work I need to safely invest or to rationally and carefully invest $1,000 is not much different than the amount of effort it takes to invest $1 billion. And the mutual funds are born out of that idea, is that they pool money together from a lot of small investors, and then they have a gigantic investment pot and use that to buy a portfolio of financial assets, right? So mutual fund obtains money by selling shares to investors. So when you're a mutual fund investor, you're not directly buying into the security, you're buying a share in the mutual fund, and the mutual fund in turn takes that money and invests that in a portfolio of financial assets. And this is essentially pooling together large sums of money, large sums of small retail investors together to make a big enough portfolio of stocks, bonds, and financial assets. And so it seems like a reasonably interesting idea, and there's a reason why mutual funds have taken off, right? So just for people who are not familiar with the terms here, portfolio, when we talk about a portfolio in general, we are talking about a collection of financial assets. They could be stocks, bonds, any kind of financial assets or securities, mortgages, whatever it is. It could be any kind of financial security. That's what we say when we are talking about when we refer to a portfolio. Hedge funds are again financial intermediaries, but they function very similar to mutual funds with higher fees, and they service a different clientele. They service a much more wealthier, more less risk averse clientele, where uh, they have very few wealthy investors. Instead of collecting money from a large pool of small investors, they instead collect money from some very few really wealthy investors and invest in slightly riskier investments, right? Put that money to use in slightly riskier investments. This is just to give you a flavor of the notion that the financial system is not just about banks, but there's a lot of other non-banking financial intermediaries which perform this basic function of taking money from savers and channeling it to borrowers who need it. Okay. All right. Financial markets, on the other hand, are marketplaces where we trade these securities, right? And traditionally, these used to be physical locations. For instance, the New York Stock Exchange, there's a physical building on Wall Street, and in the not too ancient times, even up to 40s, 50s, 60s, you would have to physically go up to the New York Stock Exchange with your, you would have a certificate, the bond certificate or a stock certificate issued to you in order to trade it. Okay. But what we have, of course, today is that most trading happens electronically through a network of computers, what we call the OTC market, the over-the-counter market, and the Nasdaq is a big example of this kind of OTC market, where there's no physical location for where the Nasdaq exchange is located. It's just a network of computers and servers which are facilitating trading electronically, right? All right. The other thing which we need to take into account is this distinction between primary markets and secondary markets, right? A primary market is a market in which financial security is sold for the first time, right? Stocks, bonds, other financial securities, they all need to be sold for the first time, right? With a stock, this is when the company goes from being private to becoming a public company through an IPO, right? An initial public offering where the company opens up ownership in its ownership stakes in its firm to the general public, right? So when a company like Tesla goes public, not only are institutional investors and small other big venture capital funds and private equity funds allowed to invest in Tesla, but you and I can also buy a ownership stake in Tesla, right? So primary markets are markets in which these securities are sold for the first time, and secondary markets are what we generally refer to as the stock market or the bond market or whatever else, where once these securities are sold for the first time, now they can be sold again and again, between where trading happens between people who own these securities and people who want to own these securities, and that's basically what happens, right? So that's the primary difference between a primary market and secondary market. When we are talking about primary markets, this is where the securities are sold for the first time, and secondary markets are where all other trading happens after the security has been sold for the first time. Okay. And here's an interesting snapshot of how things have evolved over time. Okay. Now, this is between 1978 and 2016. This is the composition of a typical household's wealth, right? So this is what people have done with their savings, and you can see that there's a remarkable transformation in how people manage their savings, right? So between 1978 and 2016, we can see that bonds have fallen a little bit out of favor, right? It was never really favorable, but it's fallen out of favor. But at the same time, there has been a significant increase in exposure to the corporate stock market, right? To the financial market, where you're buying, you're exposed to, shares and stocks of a lot of these publicly listed companies. At the same time, there has been a significant decline in the equity in unincorporated businesses, right? When we talk about unincorporated businesses, we're talking about small mom and pop operations, solo proprietorships, small partnerships, so on and so forth. But this also belies a significant transformation in the American economy, right? So where people went from owning their small little operation, right, a small restaurant or like a small mom and pop shoe repair store, whatever it is, to going into becoming workers in the economy, because the economy is consolidated significantly, right? what we've seen over the last 3 or 4 decades is waves of massive consolidation. The modern conglomerate is born through this massive consolidation of entire segments of the industry, right? So that drives out small businesses out of these industries, and many industries are now dominated by 4 or 5 or 10 or 20 or whatever, like, a small number of very large corporations which dominate entire markets, right? And that's what we've seen here, that the equity in unincorporated businesses has fallen off quite significantly. So a lot of wealth and savings used to be invested in yourself, right, in your family business or whatever it was, and that has taken a significant nosedive between 1978 to 2016. Deposits in banks have fallen significantly. People don't hold as much cash as they used to. We'll talk about why that has been the case, what has allowed for that to happen. At the same time, this is what's amazing, that mutual fund shares have risen dramatically. Mutual funds were basically non-existent, right? It was very small number, fraction of people in the economy would actually be invested in mutual funds. You have to be kind of a sophisticated investor to be invested in mutual funds, but now a lot of people are invested in mutual funds. Same time, what we see is that there's a dramatic increase in the share of pension fund reserves in household saving wealth, right? So it's almost mirroring, right? The equity in unincorporated business, the fall there is accompanied by an increase in pension fund reserves, which makes sense. If you go from owning your business and that becomes the source of your wealth to becoming a worker, then the source of your financial wealth is in pension fund reserves, right? The money that is getting saved on your behalf to finance your pension. And that you can see that this is almost a one-to-one change between the drop in equity in self-owned businesses and solo proprietorships and partnerships to a matching increase in pension fund reserves. This is a very interesting evolution where the economy goes from a family-owned business dominated by small family operations to a worker-based economy, right? Okay. So the last element that I want to talk about is about financial regulators, right? The people, the government agencies which are in charge of making sure that fraud, waste, and abuse in the financial system is limited as much as possible. Okay, so I have a few of them. There's an alphabet soup of financial regulators, if you will, but I have a few of the key financial regulators here, right? For starters, the Securities and Exchange Commission, the SEC, is in charge of regulating financial markets, right? If you're a financial market participant, the SEC is your regulator, and they're in charge of making sure that you're not engaging in any fraudulent activities, and if you are, then to investigate these activities and to find them and do all of that. And they're in charge of making sure that public companies make periodic disclosures of their financial statements and their well-being to investors and so on and so forth. Okay. The Federal Deposit Insurance Corporation, the FDIC, is the regulator which is in charge of regulating insurance, insuring deposits in banks, right? And it's a very interesting history of how the FDIC has come to be. But in a very short history of this, the FDIC came into being in the aftermath of in the history. If you look at the history of the United banking in the United States, there's a wonderful book called Manias, Panics, and Crashes, which tracks this history, that there used to be a series of massive bank runs constantly in the US economy. Bank failures and bank runs used to be like a de facto feature of the American economy. It's not just about the American economy, it was a feature of many large economies, to be honest. So you can imagine what the story would go like. Someone would pitch up a tent in your neighborhood, say that they are a bank, collect deposits, and say, okay, I'm going to make loans out of these deposits, so you'll get a nice interest rate for depositing money with me. And one fine day, they close up shop and run away with your money, right? And if this happens over and over and over again, people lose confidence in these banking systems. They don't want to deposit money in the banks because they don't know whether this bank, on what fine day you go to the bank and the bank doesn't exist anymore and all your money has evaporated overnight. And if people don't deposit money at banks, then people who need to borrow money don't have like an easily accessible source of funds, and that basically crimps how much new businesses are created and funded and take off and generate growth in the economy. Okay, So to protect against all of this, the FDIC was formed, and the FDIC's mandate is basically very simple. It collects insurance premiums from banks which take in deposits, and if the bank fails or goes under, the FDIC steps in and makes the depositors whole, right? Right now, the FDIC insures deposits up to $250,000. So if you have anything less than $250,000 in your sitting in your bank account, the FDIC will insure all of that money. So if that bank goes under, then the FDIC will make sure that you don't go under with the bank. Your deposits are safe, right? So that's the basic story with Federal Deposit Insurance Corporation as a regulator. That's its basic function. There's the Office of the Comptroller of the Currency, which basically is in charge of regulating federally chartered banks. So we won't delve into this regulator all that much, but the Federal Office of the Office of the Comptroller of the Currency, there's a difference between what we call a federal charter and a state charter. So if you incorporate yourself as a bank, you might just get a state license, which means a charter is just a fancy way of saying license, and which means that you are allowed to conduct your operations only within the geographic confines of that state, right? So if you want to expand your operations to other states, you need to get a license, a state charter from those states, and then you can operate in their territories and so on and so forth. As opposed to this, you can incorporate yourself as a federally chartered bank, which means that you're allowed your license to operate as a bank in all the US states and territories, but you're regulated much more severely and much more strictly because of the scale of the operation that you're engaged in. And the Office of the Comptroller of the Currency is basically the regulator who's in charge of taking care of these federally chartered banks. Okay. The Federal Reserve System, will spend a great deal of time in this course talking about the Federal Reserve System. It's the central bank of the United States. I'll get into details around it in just a second because I have a few slides introducing the Federal Reserve here. And the last regulator that I want to talk about is the CFPB, the Consumer Finance Protection Bureau. This is one of the newest financial regulators right now, and this came into being in the aftermath of the 2007-2009 Great Recession and the crisis in the financial markets that precipitated it, right? So if you follow your politics closely enough, this is the brainchild of Elizabeth Warren. She was the pioneer who came up with this idea for the CFPB to be a regulator in order to protect consumers. Her entire view was that the existing regulators in the financial markets were not particularly geared to take into account the protection of consumers from fraud and abuse in financial markets and the financial system in general. So her proposal was to create a new agency called the CFPB, the Consumer Finance Protection Bureau, which was tasked with making sure that consumers were protected from fraud and abuse in the financial markets, right? So that's the newest regulator that we have, and there's a lot more regulators. As I said, there's an alphabet soup of regulators in this market, but these are the big ones, right? These are the ones you definitely need to know about: the SEC, the FDIC, the Comptroller of the Currency, the Federal Reserve, and the CFPB. Okay. All right, so let's talk about Federal Reserve. Okay. The Federal Reserve is the central bank of the United States. So every single major economy in the world has a central bank, and the central bank in the US is what we call the Federal Reserve, right? It's usually just referred to as the Fed, and the Fed was established by an act of Congress in 1913 with a primary function to deal with a slew of banking problems. So again, if you look at the history of banking in the United States, there was a series of these bank runs, right? And the big problem here, which I'll get into when a little bit more detail once we get into the Federal Reserve and what its original mandate was, is that there is a difference between insolvency and illiquidity. Okay, insolvency is when the bank's assets are just lower than the liabilities that it owes. What it owns is less than what it owes, and now there's nothing you can do about this, right? It's just bad state of affairs, right? The bank is in severe financial distress. There's not a lot you can do about it. There is also illiquidity, where the bank's assets are greater than its liabilities, but it's facing a temporary liquidity problem, right? So here's an interesting story that I can tell you, that suppose the bank takes in $100 million in deposits, right? On a typical day, there's about $10 million worth of transactions that happen where people withdraw cash or for purchases or whatever it is, and that's basically what happens. So bank realizes that it doesn't want to hold all of that $100 million as deposit, wants to make loans. So it makes loans of $80 million. So these loans are long-term loans and they're going to get repaid, and keeps a $20 buffer as cash in the bank's reserves, and in order to basically make sure that everyday transactions go through without any issues. Now suppose there's one particular day that for some reason there's a higher volume than anticipated, right? So maybe instead of the usual 10-12 million that you're seeing, there's about $25 million worth of transactions that happen. Now you have only $20 million worth of cash to facilitate these transactions, and you have a liquidity problem, right? Suddenly you don't have enough cash to service all the transactions that have happened on your bank's basis, and now what do you have, right? Suddenly you have to start rejecting some transactions, and now that provokes a crisis of confidence. So your deposits in your bank think that maybe you lost some money, that's why you don't have money in the bank, and that spirals out of control. People want to start pulling their money out of the bank while the money is still there, because they might think that this bank is going to go under any time now, and that you have a full-blown bank run. As this crisis spreads, more and more people start rushing into the bank trying to withdraw their money, and then this bank can't do anything with it because a lot of their money is tied up in these loans, and those loans are long-term obligations, and there's no way to get money from them so quickly, or it might have to sell these loans to other banks where fire sale prices, and pretty soon the bank collapses. And fundamentally there was no issue with this bank was fundamentally sound, right? The bank's assets were really good, everything was great, but a liquidity crisis very quickly turns into a solvency crisis, and the bank goes under. And this is a good old-fashioned bank run, and these bank runs used to happen over and over and over and over and over again in US banking history. And the Federal Reserve was initially brought in with the original role of being the lender of the last resort, right? So when these banks, which are fundamentally sound, which are not insolvent but were facing a temporary liquidity crisis, they could go to the Federal Reserve and get some money from them in order to tide them over in the short run while they figure out how to better manage their reserves and liquidity going forward, right? That was the original mandate of the Federal Reserve, to be the lender of the last resort, the final backstop to the banking system. And basically, since we have had the creation of the Federal Reserve, the number of bank runs has basically gone down, right? So there have been a few high-profile bank runs since then, but it's not as often, or we don't see that as much anymore. Okay. So what does the Federal Reserve do? Right, so we'll talk about the Federal Reserve in a lot of detail in this course, but the primary mandate given to the Federal Reserve is to manage the monetary policy of the country, which is to say manage the money supply of the country and the interest rates in service of large macroeconomic policy objectives. Right? What those objectives are, we'll get into that as well, but the primary channel through which the Federal Reserve manages the monetary money supply in the economy is through what we call interest rate targeting. We'll talk about all of that in a second, but how do you target these interest rates and what it means to target interest rates? But the Fed in a structure is not a monolith, even though we used to talking about the Fed in the collective as the Fed, is actually divided into 12 districts. And the main policy making body of the Federal Reserve System is called the FOMC, the Federal Open Market Committee, which decides on what the interest rates in the economy need to be. And the FOMC meets 8 times a year and decides on a target for what we call the federal funds rate. So we'll talk about federal funds rate, how it's determined in a lot of detail in this course, but in this very basic sense, the federal funds rate is a short-term overnight rate at which banks lend to each other. right? It's the benchmark rate, which is in the sense that two very safe institutions, two banks which are well capitalized and well run, these are just lending to each other in order to meet reserve requirements, and these are very short term loans which these banks are making to each other, and the interest rate that is charged on these loans are what they call the federal funds rate. And the primary mechanism through which the Fed manages the money supply is by targeting this federal funds rate. And we'll talk about how to target the federal funds rate, how this federal funds rate is even determined, and how the Fed can actually target this. Okay. So here's a quick map of all the districts. So wherever the shaded region is what that federal bank is responsible for, is the primary regulator for that entire region. So in the western region of the United States, the Federal Bank in San Francisco is what's responsible for it, and you can see that there is a lot more of them. There's the Dallas Fed, the Kansas City Fed for the Midwest, the Minneapolis Fed, the Chicago Fed, the St. Louis, Atlanta, and then there is the concentration around the financial corridor in Boston, New York, Philadelphia, DC, and Richmond, right? So the Federal Reserve System, there's 12 different banks. The main board of governors is sitting in Washington, DC. This is where the FOMC meets, the Federal Open Market Committee meets, and they decide on what the federal funds rate needs to be. Okay? So the last thing I want to talk about in this introduction is about what does the financial system do. And we think about the financial system as providing three big services to savers and borrowers: risk sharing, liquidity, and information. Okay, let's take each of these in turn. Let's talk about each of them. Risk sharing, right? Before we talk about risk sharing, we want to briefly talk about risk. In a fundamental intuitive sense, risk is anything which happens which is a deviation from what is expected, right? In mathematical terms, if you know your statistics, it's the standard deviation. So if the expected value is the expectation, then any deviation away from that expectation is what we call risk, right? What risk sharing, one primary thing that financial markets accomplish is through diversification, right? They promote risk sharing by allowing for diversification, and diversification is just a financial equivalent of the age-old adage that you don't put all your eggs in one basket, right? So the financial market allows us to split wealth among different assets, different kinds of securities, in order to reduce the amount of risk that you carry. Your exposure to risk of any one idiosyncratic shock to one company is limited, because you invest in a wide basket of financial securities, and diversification accomplishes that, and the financial market provides this crucial function, right? The other thing that financial markets allow us to do is, because they allow for the financial assets to be turned into securities and that they can be tradable, this allows for liquidity transformations, right? So liquidity, when we talk about liquidity, is the ease with which an asset can be turned into liquid cash or for money, right? And financial markets provide this very crucial function of injecting liquidity into the economy, because you're not you're not stuck holding a particular set of financial assets for very long durations of the time. You can tap the financial markets at any given point in time, exchange these financial assets for money, and then you have instant liquidity, and you can use the liquidity to service any other needs that you might have. And that's another thing that the financial system provides. The third thing, and one of the most important things that the functions of the financial system does, is to provide information, right? It conveys information to both sides of the economy, both savers and borrowers. And in between all of this is a very nice notion which I really find interesting about financial markets, is because they allow for what we call price discovery. Okay, here's a story. Here's a quick hypothetical situation, and you can see straight away what the value of having a financial system is. You're sitting around one day in the backyard, you're digging up, and you find a block of gold. Okay, great, this is amazing. And you don't know what to do with it. You have no good use for this block of gold. So you say, okay, I think this might be valuable. but I don't know what the value of this is. Is this block of gold is it worth a lot? Is it worth very little? I don't know what the value of this is. What could I possibly do? I have no good use for this. I want money for it. I want to get money for it and then use it for things that I want. So I go, imagine this situation. I live in a small neighborhood. I go to my neighbor and say, hey, I found this in my backyard. This is, I don't know what this is. It was a block of gold and I don't want it, but I don't want to like give it away either. Do you want this? Can you do something with this? And if you can do something with this, would you be willing to give me some money for it? Your neighbor actually knows what gold is and thinks that this is amazing, that he's lucked out, and says, okay, I'll give you $1 for this big block of gold that you found. Now the question is, you can be a gullible person and be like, okay, great, here I got $1. I didn't know what this was. I didn't know what its value was. I don't know what is the right price for it. I'll accept this $1, go about my life. I have $1 more than I had before. Seems like a reasonable thing to do. But you don't think your neighbor is all that scrupulous. So what can you do? You go to the second neighbor's house and you ask them, tell them the same story and ask them, how much would you pay for this block of gold? The second neighbor says, oh, I would pay $10 for this. And you thank your lucky stars for not getting swindled by your first neighbor, because now you know that this block of gold, that there exists at least one other person in this world who values this block of gold for at least $10. What you have here is a good old-fashioned auction, right? You hold up an object and you accept bids on what people will value this object at. And as this auction process unravels, as it keeps going through, you are getting to discover the value of the object, or in the financial market, what we will call price discovery. What is this financial asset worth? The financial market, the stock market or the bond market or any market, is fundamentally an auction mechanism. It's a mechanism in which there's bids, right? There's asks and bids, right, in a market. So people are constantly throwing out prices. They're telling you prices at which they would be willing to buy this and prices at which they're willing to sell it, and you have constant exchange of information. And as millions and millions of people are constantly participating in this process, they're bringing with them their own pieces of information, and that constant interaction between all these millions of people is getting us closer and closer to discovering the price of any financial security or asset. And that's the crucial, amazing function that a well-functioning financial system can do, is aid in this process of price discovery, because we have a constant auction going on all day long, right? So we'll talk about what happens when each of these functions is disrupted, what happens when there's a problem with how risk gets dispersed, what happens when there's liquidity problems in the financial system, and we'll talk about when there is information asymmetries in the financial system, how that can generate massive problems. Okay, all right. So at the end of this session now, I want to quickly talk about the financial crisis of 2007-2009 to give you a flavor of why any of this matters. Why do we even need to care about the financial system and make sure that it functions properly? Okay, so let's talk very quickly. This is a very broad overview of the financial crisis, and as towards the end of this course, we will get into a lot more details surrounding the financial crisis. Okay, so financial crisis, as we said, is a significant disruption of the flow of funds from lenders to borrowers, right? So the financial system's primary role is to match up these savers and borrowers in this economy in a frictionless way, in a fraud-free way, and if there is a disruption there, then we have a problem on our hands, right? So the financial crisis in 2007 to 2009 was in large part caused by a bursting of a bubble in the housing market, right? So a bubble, when we talk about financial bubbles, we are talking about a large increase in prices of a certain class of assets which becomes unsustainable, right? So as as like a soap bubble, so it keeps growing larger and larger, but there is limits to how large this bubble can get, and once it reaches its breaking point, it essentially pops, and then we have a problem on our hands, right? So we'll talk about fundamental origins of the financial crisis towards the end of the course, and but for now the crucial thing is to recognize that there was like a lot of overly optimistic expectations made it easier for families to borrow money to buy houses, right? So there was a big push, right? If you look through the history, economic history of the United States, you can basically, if you want to take broad stroke view on the economy, there is the New Deal policies of FDR. This was during the Great Depression and in the lead up to the Second World War. There was the Great Society programs that Lyndon Johnson tried to implement during the 60s, and then there is the new Reaganomics, or the new free market, the new classical free market policies of Reagan and Margaret Thatcher in the United Kingdom. This was in the 80s, right? So there's three big beats, if you want, in the last 100 years of US economic history. There's three big beats that you definitely need to be aware of about the New Deal programs, about the Great Society programs, and the orientation towards deregulated free markets that Reagan introduces in the 1980s, right? So, but the point of all of this is that there was a lot of big push for home ownership as a pathway into the middle class for the American household, right? And there was Fannie Mae and Freddie Mac. These were government corporations, government-backed corporations, which were incentivized to help homeowners borrow by selling bonds to investors and use the funds to purchase mortgages from the banks, right? So they would Fannie Mae and Freddie Mac were government agencies which were in the business of lending money, right, by lending money to these investors, and then or borrowing money from these investors and using that money from these investors to underwrite mortgages, right? So we had like a perfect storm of sorts. One was that there was a lot of housing demand because housing prices had been going up for a very long time, and housing seemed to be like as a sign of coming into the middle class, as a signaling as a pathway into the middle class. And at the same time there was a big push from government agencies in order to facilitate this as well. So we'll get into the details again towards the end of the course, but this is again a quick introduction to financial crisis. So investment banks also were very interested in this mortgage market because investment banks' interest was belied by, they were not by two fundamental trends that we observed in the housing market. One was that housing prices had been rising steadily for close to 4 decades at that point, right? Since the 60s, housing prices have steadily kept rising and rising and rising in the United States. So it was an asset whose value had been rising for a long time. And the second part of it was the fact that it was collateralized, right? So suppose you are invested in a mortgage and then the person stops making mortgage payments. All you have to do is take possession of that house because you own the asset, and then sell it to somebody else, turn it around, sell it for a profit, and then you're fine because that financial security that you own is collateralized by the underlying asset, which is the house in this sense. Okay, but and that seems all great. It seems nice enough. Seems like a good business to be in, and it was, as long as the people who were buying houses or people who were lent money in order to buy houses were prime borrowers, which meant that they use credit reasonably prudently, that they had large enough incomes in order to make these mortgage payments without any with very low probabilities of default. As long as that was the case, this business was a good business to be in. The problem arises when you run out of prime borrowers to lend money to, right? So there's only going to be so many people who have amazing credit, who have good incomes, and who you can basically lend money to safely, and there's only so many of those who you can make mortgages to. So once banks began to run out of those people and there was still an insatiable demand for these mortgage-backed securities from investors, the next thing was to loosen the standards, right? Instead of limiting mortgage underwriting to prime borrowers, there was the creation of this new market, which was called the subprime mortgage market. So subprime mortgages, as the name suggests, meant that you would lend money to people who had subprime credit, less than great credit, in order to purchase these houses, and banks were not particularly too worried about this. We'll talk about why they were not worried about this, but the same two trends about rising housing prices for decades and the fact that it was collateralized by the underlying house gave them a false sense of confidence that even if there were defaults in these markets, that they would be okay. The problem obviously comes through when the defaults are not one-off, but then they become systemic, right? In 2006, housing prices began to decline, and as housing prices began to decline, an interesting thing happens, right? Suppose you borrow $1 million, right? You want to buy this house and you borrowed $1 million from the bank. If housing prices decline, suppose it's a 20% decline in housing, that's a big drop, but just to illustrate the point, that house that you owe $1 million to the bank to is now worth only $800,000. What is a rational thing to do? It doesn't make sense for you to continue to make mortgage payments to the bank for an asset for which the bank is lent $1 million to you, but if you sell it today, you wouldn't be able to not only get the $1 million to repay the bank. If anything, you would get only $800,000 and you would still owe the bank $200,000. What is the rational thing to do here? You walk away from the mortgage. You say, okay, bank, I'm not going to make any more mortgage payments because it doesn't make sense. I am quote unquote underwater, which is to say the value of the liabilities that I own to the bank is greater than the value of the asset that I've used that money to buy. So I'm just going to walk away from it. I'm going to stop mortgage payments and you can have the house. I don't care. I'm going to find some other house to live in and you can have the house. So the bank is okay. All right, I'm going to take the house, and they're okay with it so far. They're going to put the house back on the market and hopefully they will recoup their money. But as more and more houses and they put this house on the market, other people's houses in the neighborhood are also going underwater, and slowly there is an increase in the supply of houses in the market, right? If supply increase is greater than the demand, simple supply and demand dynamics tells you that price needs to fall, right? If there is more supply than there is demand, then prices need to fall. Demand was not very high. Supply was, as more and more houses were foreclosed on and were brought to the market, there was a big increase in the supply of houses in the market and prices began to drop. As the prices began to drop, more and more people were underwater on their mortgages, so they started walking away from the mortgages, which only served to increase the housing supply onto the market, which meant the prices were falling, and more and more people were underwater on their mortgages and walking away from it, and very soon the entire market explodes. Okay, and that's the basic story of the financial crisis of 2007-2009. What starts off as a small problem in the housing market then goes into a full-blown economic crisis, right? So here's a couple of graphs. This is from the Federal Reserve in St. Louis. So here you can see new home sales from till 2006. It begins to rise and then there's a precipitous drop off, and it hasn't recovered since then. It's slowly recovering, but you can see the same thing. Again, the index of home prices here, this is what it's from the Case-Shiller index. You can see that housing prices had been rising for a long period of time. Of course, the timeline here starts from 2003, but if you go back, you will see that this trend continues into the last 30 decades. The last 3 decades, and then there is a drop in housing prices, and then we have this housing crisis on our hands. Okay, so as all these mortgage-backed securities were owned by a large number of banks, a lot of these banks were starting to realize massive losses, right? And a lot of these banks began to get distressed, and the entire financial system was on the brink of collapse. Bear Stearns and Lehman Brothers were the first to feel the pressure, but pretty soon the entire financial system was under siege. right? So in October 2008, Congress really quickly came together and passed what was called the TARP, the Temporary Asset Relief the Troubled Asset Relief Program, in order to inject a lot of liquidity into banks. And they did this by becoming part owners in these banks. For a brief while there, the US government was a big owner of the largest banks in the United States, and this is the era where this phrase "too big to fail" is coined, right? That these banks are so large and so structurally important to the edifice of the US financial system that if one of them collapses, then the entire system might collapse with it. Okay? And the Federal Reserve and the Treasury embarked on a series of very novel, very aggressive policy actions, which we are feeling the tremors of and the after effects of even a decade since the end of the financial crisis, right? So some things that happened during this period was that there was partial government ownership of private firms, of private financial firms. The government owned outright a big chunk of the equity of these firms. There was implicit guarantees to financial firms that they would not be allowed to fail, right? This is the problem of too big to fail, or what we call the Fed backstop, where the Federal Reserve had committed itself to not letting the big banks fail. Okay, and there was unprecedented intervention in financial markets, so what we call quantitative easing, QE. This is completely unprecedented. It had never been tried before. It was the first time in the financial crisis that this entire notion of flooding the markets with liquidity was employed. And what we learned from the same story, from that 2007-2009 intervention, is this is exactly what the Federal Reserve did to tackle the coronavirus pandemic. As the economy ground to a halt, as the pandemic has taken hold, the Federal Reserve has just flooded the markets with liquidity. It has learned that valuable lesson from what happened during the Great Recession of 2007-2009. Okay, so many fear that all of these Fed's actions might reduce its independence, and we'll talk about why those fears are well founded, or are they, right? Why do we even care about the Federal Reserve being an independent body? We'll talk about all of that during the course of this semester. Okay, so this is a quick introduction to the course and what to expect from this course. So if there's any questions, you can always leave them in the comments below the video, or you can send me an email or see me in office hours. I hope that was clear. I'm really excited to get you started on this in this course. I think my hope is that you learn a lot here. I think there's a lot of real world knowledge to be gained from this course, and you come away with like a slightly better understanding of how the financial system works. All right. Thanks again for listening, and I'll see you in the next one. Bye bye.